As 2023 comes to an end, investment themes are already beginning to take shape for the next year, for the new year, I should say. Joining us right now is Elizabeth Burton of Goldman Sachs Asset Management. And Elizabeth, we're looking at some moves this morning that are kind of crazy with things running up, people expecting rate cuts are going to come down. Do you buy it? And if so, if you think that's really the story, what do you tell people to do with their money?
Our position remains that rate cuts are unlikely to happen until the fourth quarter of next year. We think that the Fed has been on a pretty good trajectory and will stay where they are. But things can always happen and we can reevaluate. So I wouldn't be making market moves right now based on what's happening.
So do you think the runs that we've seen in places like the equity markets and gold and Bitcoin, are those overdone as a result? Because we keep saying those things are on the move because it looks like rate cuts are coming sooner.
I don't know if they're overdone. What I would say is I think we're going to be in a range-bound area, at least for the next 12 months. I think there's a really tough case for further upside in equities, mostly because to have that happen at this point, we're going to have to see some margin expansion. And I don't know that we're really in that position just now.
So what do you tell people to do? Wait and buy wait for a dip and then buy?
So as a former allocator, I mostly focus on asset allocation as one of our big 5 themes for 2024. And there's a couple things I think are important. One, a lot of allocators are underweight to commodities. In fact, they took them out of their portfolios about a decade ago. I think commodities are going to be important. If you think inflation is going to be high and sticky for some time, I think that's going to be helpful. And there's some tailwinds behind the green energy transition for certain parts of the commodities complex. I also think with Sharpe ratios coming down, right, so we are expecting lower returns to equities across the board, but volatility is higher. So it used to be hard to allocate ex-US if you thought the Sharpe ratio was higher there. But when Sharpe ratios across the board and equities are 0.2 to 0.3, it makes it easier to make the case that you need geographic diversification. In addition to that, I think private markets are a good place to play when you're in this sort of range-bound area with low equity risk premium.
What kind of private markets?
I'm sorry?
Where in the private markets?
So we really like real estate credit. We like private credit. We continue to like parts of private equity as well. And I know that a lot of folks are scared of real estate. There's a lot of really unexciting and upsetting things that happened over the last 24 months. But that should set the environment, both in the US and Europe, for some opportunities into next year. One thing that concerns me when I talk to allocators is that the themes that they're talking about in real estate. So I'm sure on this show you've heard a lot about people talking about life storage. Or self-storage, everybody's talking about it, right? So when everybody's talking about one part of the market, you want to be thinking about what the next part of the market. And European real estate can have very different behavior characteristics, especially in office, than the U.S. market. So it's important to look not just in your home territory, particularly now when most U.S. institutions, for example, have overweight biases to the U.S.
Have prices come down enough in the office market so that you think there are potential opportunities there or not? We had Mario Peoples on Friday last week, and he was saying, not yet, like, take it down. Don Peoples.
Don Peoples.
We have Angelica Peoples. We have a lot of Peoples around.
Seems to be the consensus. We just finished our European real estate conference, and the consensus is there's further to fall. I think it's very difficult to pick an entry point in any sort of market. So if you think something's good from a valuation perspective, it's always time to take a look.
I have a different question.
Sure.
So the base case that you have and the rest of the market has, for the most part, is that interest rates are going to come down.
Sure.
The Jamie Dimon case is that interest rates are not coming down. In fact, they might even go higher.
Right.
So if that happens, is there, to the extent you wanted to hedge for that, if you were going to, how would you do that?
Well, for one, I don't think it's wrong to assume that the upside risk remains in rates. If I was still managing a pension portfolio, which I used to do, I would be thinking about what if it is higher and what if it's going higher. That's a major risk to U.S. pension portfolios. Right. So, look, rates are high. They're not the highest that anyone at this table has seen. When I was working in mortgages and, in 2004, they were higher than they are now. I grew up on a farm and we had like a 17% mortgage. So if a farm has it, people can pay these sorts of rates. But I think, this isn't rocket science, but look for floating rates, look to real assets, look for diversification. The same playbook you did over the last 3 years probably won't work exactly as you think it will. We're not going back to 2019. Right.
Also, as it relates to private markets, how do you feel about private equity now, given that I would assume at these kind of prices, there's not going to be that many great deals out there, unless you think that there's going to be all sorts of just messy things out there that'll be available?
It's a very hard argument to say you should stay out of private equity, right? You need vintage year diversification for that to happen. My bigger concern is that we'll see consolidation in the private equity industry. So the capital will be going to
the firms, the GPs.
Yeah.
Okay.
I think we'll be seeing larger deals, but I don't think it's time to get out of private equity. Maybe you become more selective, especially since a lot of institutional portfolios don't have a lot of liquidity. They can be more selective in this environment. But I remember when we had vol shocks in 2018 and people were asking, are people still trading vol? I mean, that's sort of a silly question. People don't stop trading markets because there's a hiccup, right? So I think you just get to be more selective in what types you're trading.
What causes that consolidation?
In the private equity markets, look, I think this is a very hard time and environment for really small firms to try to raise capital when institutional investors are really liquid, the denominator effect, right? And also the back to work phenomenon. If you go to visit an allocator and they're only in the office 2 days a week, you better make sure you're visiting them on the Tuesday or Wednesdays in the office. So the face time is harder to get, right?
You worked at a pension fund in Hawaii. You've got a pretty diverse background.
I did. I worked at a Maryland pension fund as well.
Hawaii's better.
I'm not going to make a comment on which is better. Both have interesting.
I'll go out on
from a location.
I'll go out on a limb there.
It's led me to have a unique perspective on how the $5 trillion in pension fund assets in the U.S. move. And it may not seem like a lot of money, but if they move 1 or 2%, that can meaningfully affect things.